Hello there and welcome to myfinanceteacher.org. As recently requested, let's have a look at what's going on with Equinox and B2Gold, two relatively large established miners. The data that we're going to look at today is based on their Q2 2025 report. As usual, looking at valuation of established miners, we are generally going to look at discounted per share value after all-in sustaining costs, long-term debts and taxes. While there is a range of factors that we feed into this model, such as gold price, reserves, all-in sustaining costs, debts, taxes, number of shares outstanding, we do look at time value of money, as well as the alignment between insiders and the rest of the shareholders. This, of course, is not an exhaustive list of what might happen to the company. A lot, for example, depends on, say, decision of the managers. Dilution becomes sometimes important, especially for less established juniors. Nevertheless, what we do have here, again, the per share value after all these costs, does give you a bit of an anchor to where the, so to speak, fair valuation might be. Looking into the valuation, we're going to look at three scenarios. All three are generally conservative, with the actual conservative scenario plugging in the gold price of only $2,800, balanced scenario plugging in the gold price of $3,200, and in our optimistic scenario, we are pretty close to the current gold price of $3,600. Moving on to reserves and resources, we see that Equinox has quite a bit more in the ground compared to B2Gold. Equinox has more than 23 million ounces in proven and probable reserves of gold, and an additional, beyond the reserves, Equinox has measured and indicated resources of gold at over 22 million ounces. B2Gold has significantly less at 7.5 million ounces of proven and probable reserves of gold and an additional 11.4 million ounces of measured and indicated resources. But B2Gold has a significantly larger margin, with all-in sustaining costs as guideline for this year at $1,520, whereas the all-in sustaining costs for Equinox as guideline for this year is at $1,850. Hence the margins are much more attractive with B2Gold, but the leverage to gold price is cranked up higher at Equinox. Moving on to the rest of the data, we subtract long-term debts from our valuation, which are at over $1.5 billion for Equinox, while B2Gold has only $420 million in long-term debts. The number of shares outstanding is much smaller with Equinox at over 782 million shares outstanding, whereas B2Gold has over 1.3 billion shares outstanding. I do like that insiders hold quite a significant amount, according to Yahoo Finance, at 4.43% of Equinox. This number is only less than 0.5% for B2Gold. Looking at the time value of money, I'm going to use a discount rate of 7%. If you'd like to adjust that, let me know down in the comments below which level of discount rate would you think is appropriate. And of course, we apply this time value of money to the average mine life, which is at 27 years for reserves of Equinox given the current annual production. For B2Gold, that's at 7 years of reserve mine life. Adding only half of measured and indicated resources increases the average mine life to 40 years for Equinox and to 13 years for B2Gold. As for taxes, I'm just going to assume a flat tax rate of 25%. We also show cash here. It doesn't actually enter into the valuation model, but shows up here as an additional risk metric showing the amount of liquidity available for ongoing operations. And the cash is over $400 million for Equinox and over $300 million for B2Gold. With all of these data in mind, let's have a look at the actual valuations once we plug in the gold price. But before that, let me remind you that for much more details on juniors in metals, which are very likely to outperform B2Gold or Equinox if the bull market in precious metals continues, remember that throughout these bull markets, we often observe capital moving from the top tier miners, Newmont, Agnico, including Equinox, B2Gold, moving down the food chain into those juniors, which crank up the torque and provide very attractive gains. For a discussion of a range of most attractive juniors, make sure to join us at myfinanceteacher.org and have a look at this category, juniors in metals. Beyond that, of course, if you are interested in what's going on, say, in uranium, natural gas, crude oil, or even general stock market, we have some interesting pieces on those as well. Moving on to our valuation numbers, let's start with the conservative valuation, where we plug in the gold price of only $2,800, and in this scenario, we look at only proven and probable reserves in the ground, without including any of the measured and indicated, never mind inferred resources. With the P&P reserves only, discounted per share value after all those costs is over $8.80 for Equinox and close to $4 for B2Gold. Current market price is, of course, somewhat higher, so you might look at this valuation as some sort of a risk metric showing where the equity prices might drop to if gold just drops out of bed here towards this $2,800. Moving on to the balanced valuation, we still stick with proven and probable reserves only. In this case, we apply the price of $3,200 per ounce of gold. This gives us a discounted per share value at over $12.8 for Equinox and at $5.3 for B2Gold. And lastly and most excitingly, looking at the optimistic valuation, we look at the value of proven and probable reserves in the ground, as well as only half of measured and indicated resources, never mind any of the inferred resources. So even in our optimistic valuation, we still lean heavily towards the conservative side. We plug in the gold price of $3,600 and get the valuation of $22 for Equinox and $10.50 for B2Gold. Very exciting numbers. At the moment, we see that the current market prices are somewhere between the conservative and balanced valuations. So corresponding that to the gold prices that we plugged in, we might say that these established miners are pricing in gold price somewhere around $3,000 to $3,100 only. So there might still be some room for the miners to catch up a little with the gold price, which is, remember, again at over $3,500 right now. Beyond that, there are a lot of interesting, what I would call highlights that haven't been included into our valuation model, but might still contribute quite a bit to the re-rate. For example, we haven't looked at inferred resources in either of the cases, which are at 14 million ounces for Equinox and at 8.9 million ounces for B2Gold. Beyond that, we have a lot of interesting projects coming up or ramping up. Valentine Mine, for example, that has started operation recently this year. So starting from zero this year, it's going to ramp up to 180 kilo ounces per year of annual production. That might happen by the end of next year. Greenstone is ramping up as well from current level of 240,000 ounces to the expected level of 330,000 ounces, perhaps again by the end of next year. Arizona, that's in Brazil, is expected to ramp up as well from the current 100 kilo ounces to the expected 140 kilo ounces. With all of that production increasing over the next couple of years, all-in sustaining costs per ounce are expected to drop from the current $1,850 all the way down to $1,500 sometime in the next couple of years, so let's say by the end of 2027. And Equinox suggests that in the next couple of years they will start returning capital to the shareholders in earnest. That might also bode pretty well for the share price. Moving on to B2Gold's upcoming projects, Goose Mine, that has recently started production as well, is going to ramp up to commercial production. Again, let's say sometime into next year. The actual numbers, we'll have to see about those. Fekola Regional is ramping up from the current 20 kilo ounces to 180 kilo ounces, again perhaps into the end of next year. Gramalot development project is expected to start production in the next 3 years or so and might ramp up to 200 kilo ounces in the next 4 years. Yes, this is a bit of a long-term outlook here, So it's not really likely to affect our valuations into, say, the end of 2027. But the drop in all-in sustaining costs might actually have a role to play. It's expected to drop from the current $1,520 down to $1,360, given all this increase in production, again by the end of 2027. Another very interesting highlight here for B2Gold, which I do like quite a bit, is that B2Gold actually owns quite a bit of very interesting juniors. They own 9%, over 9% in fact, of Snowline, 6% of Founders Metals, and some other smaller juniors. When I say smaller, Snowline, for example, currently has $1 billion in market cap, while Founders Metals has a market cap of $300 million. So 9% and 6% of those numbers is something substantial, and it doesn't even go into our valuation models, suggesting that there is still some potential for the market prices to catch up with our valuation and for the valuation numbers to perhaps improve over the next couple of years. That is all on Equinox and B2Gold. For discussion of the most promising juniors, again, join us at myfinanceteacher.org. For now though, let me leave you with this question. If you only had to choose one, let me know down in the comments below which of these would you choose and why. That is all for now. Have a marvelous Monday. Bye bye.